That's because you didn't see foreclosures. And so the buyers of those end bonds, they're buying an income stream and a rate. They say, hey, we can make 6% if we buy this. And you, when you check the box in your 401k thing, oh, that piece is making 6% for me. I want some of that. That works very well, and when people are chasing yield, those markets work very well until there's a sign that, oh, that 6% wasn't guaranteed. That 6% used to feel like a CD in the bank because it was paying every quarter. And so the money was flowing into that sector, tightening the spreads. And then as soon as you start to see the foreclosures begin to happen and everyone goes, well, wait a second, the 6% isn't guaranteed, you see a fallout. You see a fallout of there that's occurred, and you see where, you know, as the Fed funds and the cost has dropped, the cost of borrowing hasn't dropped precipitous on the mortgage side, and that's because of some of the bigger factors that have gone on that we'll get into. Another piece to this is there's a big difference, as we talked about, between conforming and jumbo. And essentially you saw the conforming market increase, and you saw the jumbo market disappear. Not new information, but when you look at the data, you can see how sharply the cost of borrowing from a jumbo went on a historical standard. And you see it reining in, and we would expect it to continue to rein in on a cost basis. We do see that it's going to be a long time before the advance rates, the percentages that you can borrow against houses, are going to return. Again, a slide kind of showing where what government intervention really did to the market as a whole. You see blue, the subprime, and basically subprime has disappeared, although I would argue that a lot of the subprime is now in Fannie and Freddie qualified in different forms. And then you see the jumbo market, and you see how large it was in 03 to 08, and you've got a couple of pieces there. Obviously conforming is now bigger, so less stuff is considered jumbo, but you also have the challenge that there just is no end jumbo buyers. So if as a bank or a mortgage company you make that jumbo loan, I don't have the ability to sell that on and go make another loan. It what they call clogs the balance sheets, meaning there's only so many of those you can hold as a financial institution, and once you're full, you're full. Where previously you were full, you sold it on to someone turned it into a bond because they had the dollars they had the buyer of that bond. So you've seen that market completely dry up, but you're beginning to see the formations of that again. And one of the pieces I didn't mention about the bank is we've invested heavily in a capital markets group, which is very out of character for a community bank of our size. And it leads the regulators to notice that it's very out of character and have a very interest in terms of what we're doing. But we have about 20 individuals that came from primarily from B of A that have focused in this secondary marketing aspect, that have spent their time in their careers in we consolidate all of the individual mortgages, turn them into bonds, sell them off into the next market. So, and then what they also do is trade those. So when someone buys a bond and somebody wants to sell it, and these are primarily institutions going from one to another because they view interest rates going up or down, or they view foreclosures changing. So we have a very unique, for our size bank, insight into what's happening in that market. And that secondary market and the restart of that secondary market is what will lead to more liquidity in the jumbo space, basically meaning that banks will have the ability to make more loans because there's somebody else that's buying them. And what we're seeing in that space is very interesting. You know, the traders, it's interesting commentary because the traders are very upset, and you know, if the traders make trades, we make money, just like when you sell houses, you make money. So when there's no trading going on, that's not a good thing personally, but when you see markets stabilize, that's a good outlook for the future. And we're seeing those markets stabilize, and we're seeing a number of the government programs where in the last 3 to 6 months, the government has funded the larger banks, so that's not all, it has interesting consequences, but the larger banks have basically come in and bought up the mortgage market. So what's happened there is because the bigger banks have gotten funding from the government that's allowed them to really take all the supply out of the market, now the guys that are running the little funds that are your 401k funds are saying, ooh, we're trying to get 3, 4, 5% for these people, and we have nowhere to go. And on the capital markets desks right now, we're seeing these end investors saying, hey, we're trying to find some product. There isn't loan product out there, and because there's been less of this loan product made that isn't simply getting sold to the government, which would be all the stuff at the top. If you look at how much product is available to the secondary market on that piece, it's an eighth. And so as the rest of the product supply has been taken out of that market, now there's people that are interested in coming back and trying to say, well, we want to get into yield. And the question is, well, how much risk are we willing to take in at what yield? And so you're seeing people start to nibble back at the jumbo market on a consolidated basis. It's still far more interested in 60% advance rates than 80% advance rates. But you're beginning to see the markets rekindle in that. And internally we would cite that is significantly related to the government programs that they've put forward. This again is simply showing that the increase in FHA and the VA aspect of the market, which is a part of what they call the GSEs, the other parts being Freddie and Fannie. And then the other thing that's happened in this industry that's very interesting is the supply of potential lenders. I mean, it's no secret that obviously mortgage companies and banks have been significantly on their heels because of what's happened, and their business models have been changed. If I'm a mortgage company, I'm used to selling these things on, and all of a sudden someone says you can't sell them on. That's basically what happened overnight. The business model was already done. And I think we saw some of the effects of this to the larger mortgage companies and even some of the mortgage companies in our area. And so you see here from 2007 the number of mortgage lenders, which would be banks as well as mortgage companies, people that were set up and had the ability to close on mortgages. We declined by 17% from 07 to 08. The 09 data isn't out. We'd suggest that it's that or bigger. So within 2 years, you've probably seen 40% of the players disappear from the market. Again, something that anecdotally everyone knows is that there's nobody out there that's making these loans. When they are out there making these loans, they're only loaning to people that don't need the money, and that's not really helping to start the economy again. But what we're seeing on the leading side is the people that are buying the bigger pools are becoming interested and available, and we're working with those types of people to put programs together that then, for us, a bank like ours, allows us to go make these loans and have a market that we can move them forward that allows a financial institution to get in bigger place. Now, this is the changes that's happening at the small bank level. That change has been happening at the big bank level. The very first trades were set up to recapitalize the big banks. The big banks made a fortune in the last 2 years in the mortgage business. And they were basically borrowing TARP from the government, which gave them the ability to borrow at the Fed window, which was the little blue line, and then they were turning around and lending it out in mortgage. They tended to be lending it out in the pieces that they could then sell on to the government at any time, the stuff 725 and below. Because if you think about it, somebody gave me the money, then they lent me a whole bunch more money, I made a product that I can make money on, and they've told me they're going to buy it from me. Back it up. Back it up. And that's what they did. You look at a company like B of A, and they announced, we made, I remember last quarter I seen when they said, we made $3 billion in profits, and we were in some conversations with the Fed, and the Fed was quite angry that they came out in the first quarter of last year and announced a profit. So I dug into it, and I don't usually spend a lot of time looking at B of A financials because it really doesn't have anything to do with what we're trying to do and as entrepreneurs at our bank and make money. But you looked at B of A and they said, we made $3 billion, and then you look deep into their quarterly statement and it said, well, we also wrote off $10 billion, and we put 20 into a special reserve. They made $30 billion in the quarter, and they made it all on this mortgage trade. So the big banks were set up to go make the mortgage trade. Small banks weren't. And the reason small banks weren't is it was a low margin, high volume business. Again, going back to that first slide where you saw the period before where it was the spread was like this. When the spread fell off the table and became large, the big banks were able to do that. But the evolution of the mortgage market is going to be different, and one of the reasons our bank is interested in that is we view there's going to be more regulation going forward. They've already begun to put those clamps. You're going to see more mortgage-related activity happening in banks.